Hello there. Welcome to the Open here on BNN Bloomberg. Let's get to the big stories we're bringing you from our newsroom. Shares in Tesla suffering in the pre-market, even though the company posted a beat on earnings in its latest quarter. However, Tesla says capital spending will top $25 billion US this year, well above expectations. The company is ramping up investment in artificial intelligence, humanoid robots, and its CyberCab platform. CEO Elon Musk says the heavier spending is meant to set the stage for much larger vehicle production down the road. Tech Resources posted first quarter profit that more than doubled from a year ago. And the miner posted revenue that was also ahead of expectations, coming in at nearly $4 billion. Tech says the quarter was driven by higher copper sales and solid operations. Of course, the company is still working on its deal in which Anglo American will buy the Canadian metal producer. Shareholders have approved the deal, but some regulatory approvals are still pending. And shares in Lululemon down in the pre-market. The company says former Nike executive Heidi O'Neill will take over as CEO. O'Neill spent more than 20 years at Nike and is set to step into the role in September. She takes over at a tough time for Lululemon with weak sales, rising competition, and a recent sizing controversy. Lululemon shares are down more than 35% over the past year. Looks like we're going to get a weak opening today. Iran and the United States still facing off in the Persian Gulf region. The Americans have boarded at least one Iranian-linked ship. And U.S. President Donald Trump says that blockade of Iranian ports will continue. Let's have a look at how the TSX traded yesterday. And it has been rising and falling, partly in tandem with oil prices. Speaking of which, let's have a look at oil. Because we did see strength in oil. You can see it's up around one third of 1% on uncertainty over when the Persian Gulf, the Strait of Hormuz, will be fully opened. And let's have a look at gold to see how it's faring. And gold pretty flat this morning. And the Canadian dollar, it's holding its own as well, 73, just over 73 cents US. You can see it's had a bit of a rally lately. And Bitcoin, let's check out how that big crypto is doing. It has been in a gentle updraft, I guess you could call it, but still stuck below that $80,000 mark. U.S. stocks, of course, have been hitting record highs over the past week. Looks like we're going to get a pullback, though, today. Peace talks in the Middle East apparently in limbo. The S&P, though, has had a pretty good month, up around 9%. Earnings have stayed strong, and there's been this consistent advance in chip makers. Let's get more from Christine Tan, portfolio manager at SLGI Asset Management. Christine, great to see you. Thanks very much indeed.
Great to see you, Andy.
Still no resolution, it appears, in the Strait of Hormuz, and Iran and the Americans either harassing or boarding ships still.
Yeah, we continue to wait for a resolution or further indications of at least the two parties getting closer together. I think there has been fairly good communications from both sides as to where the sticking points are. And a couple of the key points are still quite far apart. But for now, I think we're heading into earnings season, more so in the U.S. Canada is a little bit behind in terms of when our earnings season will begin. Mm-hmm. But the focus is back again on the micro versus the macro. But certainly, at least for this morning, you are seeing a little bit of volatility, just waiting for more positive developments out of the Middle East.
You reckon that one reason investors are basically optimistic, bidding equities to record highs or near there, is that they feel that this war is unpopular with the U.S. public, and that the White House would like to resolve it in the near term.
It does seem like, at least from what you see or you hear, that this is an administration that would like to find an endpoint. I think they had clear objectives in their mind that they wanted to achieve, and in the ideal world, they would like to sort of get there, finalize the ceasefire, and perhaps form a longer-term agreement, particularly around uranium.
Oh yeah, but still, apparently, in large measure, the Iranian nuclear program intact. It's not clear whether President Trump has achieved his stated goals of halting that program.
Yeah, it remains unclear as to where the status of that program really is. You're right.
Yeah, oh yeah. I mean, the world is wondering. Canada, you think? Obviously, the world economy is being shaken to some extent by this surge in energy prices. It's not great for us here in central Canada. We bring in oil at global prices or close to it. But it's an economic shock absorber for Canada, though, a higher oil price.
In a way, it is. It depends on where you look at for the economic impact. So Canada is a net energy exporter. We are also an energy producer, so higher oil prices is positive for our national income. But as you pointed out, Andy, there are regional dispersions. So Western Canada is a net producer. Eastern Canada is a net importer, and ultimately the higher oil prices will affect the parts of the country that are buying oil from global markets. But compared to other countries, especially in North Asia, like South Korea and Japan, where they are just net importers of energy, Canada's status as a large energy producer is a shock absorber in the current environment.
It is interesting. Excuse me. It is. Oh, I'm good, thanks, Christine. It is interesting, though, that this apparently has some consumers thinking about electric cars and may give a further impetus to nuclear power development.
That's right. So you are seeing, especially in Europe, electric car interest has increased. Really, it's a bit of a global phenomenon. But in Europe, you are seeing governments revisiting renewables. In many parts of Asia, if you look at how Pakistan has fared versus other Asian countries, Pakistan over the last 5 years has almost doubled their solar capacity in terms of energy generation. So even though they are a large importer of energy as well, that is partially sort of protecting them a little bit and making them slightly more resilient than some other Asian countries. So to your point, Andy, this what's happening to oil prices, the volatility, the uncertainty, because in our case, we're dealing with high oil prices, but there are certain countries in Asia that's actually fundamentally dealing with supply. So even if they're willing to pay, they might not be able to access the supply that they need, given that their reliance on the Middle East. You've also been hearing and reading a lot more about the shortages in jet fuel. That's another item that, again, depending on where you are in the world geography, you are facing a very different world in terms of fundamental shortage of supply, even if you're willing to and able to pay the prices.
And just, Christine, we're tight for time, but you guys have tended to overweight U.S. stocks lately?
So we've been very tactical in the last few weeks. Shortly after the sort of war began, we did go underweight EFI because of the exposure that Europe has, and particularly to higher energy prices and the supply shock. And then we did close that out. More recently, we did sort of go slightly overweight U.S. equities. It is an opportunistic call, given how much U.S. equities had pulled back at that point in time.
Christine, thank you very much indeed. Christine Tan of SLGI Asset Management. Coming up, we'll take another look at the markets and check out a few stocks that are on investors' radar. Let's have a look at markets around the world, and we'll see how major Asian markets finish the day. Now, we have seen North American oil futures up a little bit today. You can see there was selling in Asia. there's a stream of headlines out of the Persian Gulf region. U.S. President Donald Trump has ordered his Navy to shoot any boats putting mines in the Strait of Hormuz. Small boats, though they may be, there is to be no hesitation. The Strait still largely shut down as the Americans maintain their blockade on Iranian ports, and Tehran, too, choking international traffic. And of course, that's particularly threatening for Asia because so much of its oil comes from the Persian Gulf. And let's have a look at Europe. Europe, too, caught in something of a vice with these higher energy prices. You can see selling in Britain and in Germany. France holding its own. It's a frustrating situation for Europeans, of course, this war that they're not directly involved. I mean, they don't have their forces in there, is threatening their economy. In Paris, L'Oreal shares soaring, sales climbing, customers snapping up some of their fancy shampoos, and La Roche-Posay skin creams. Investors betting on a rebound there. And let's have a look at where the TSX finished the day yesterday. It did gain a bit. It's still down, though, from its record high, March 2nd, of just over 34,540. So stocks, despite the strong oil market, stocks can't get back up to record levels. However, our market has outperformed this year. It's up just over 7%. The S&P 500 is up just over 4%. And there were some movers yesterday. Curaleaf soaring. It does look as though the Americans are moving decisively towards some kind of relaxation of the rules on cannabis. The federal government has now labeled, the U.S. Justice Department has labeled state-regulated marijuana as a less dangerous drug. That was a long-awaited move. And you can see Rogers up, investors apparently welcoming a cutback in capital spending. Okay, Canadian marine technology company Kraken Robotics, I love that name, expects to close a $615 million acquisition this quarter. And of course, it says geopolitical tensions are producing more inquiries for its products and services, which include underwater sensors, batteries, and seabed imaging. We heard from Greg Reid, the president and CEO.
We're a subsea robotics company, and really we focus on the maritime security market for the defense industry. And then we also, for the offshore energy industry, we provide a range of solutions for asset inspection and monitoring of infrastructure on the ocean floor.
Okay, you reported earnings just last week. There was a bit of a miss for Q4. What led to that?
Yeah, I think looking at the full year, we showed good growth on both the top and bottom line for the full year. During Q4, we had a few orders that slipped into the first half of 2026 instead. Putting things in context, we were a business that did about 10 million in revenues four plus years ago, and last year we had record revenue of over 100 million, almost 25% EBITDA margins. And I think prior to this announcement of the Covelia acquisition, we reaffirmed that our forecast for 2026 is for revenues of more than 60% growth year over year, and corresponding high margins again like we had last year. So the quarters can be lumpy at times, but overall the business is seeing a lot of good demand, and this acquisition is something that we're definitely excited about.
Yeah, let's talk a little bit more about the acquisition. It is a $615 million purchase for you. What do you see the benefits coming from Covelia Group?
It's really transformative for our overall business. It checks a lot of boxes. We had some common customers on the defense side, and from the technology point of view, our technologies are quite complementary. So if you think about the underwater drone space, some of the largest customers in the world. We are providing key systems and subsystems into them, and the Covelia Group adds additional content in those underwater drones. So, for example, excuse me, we would provide the batteries, the synthetic aperture sonar, from Kraken, and then now with Covelia and some of their subsidiary companies, we also can provide navigation, communication, forward-looking sonar, a variety of other technologies. So we are really the key supplier of subsystems into a number of these major defense contractors in the market.
With what is going on in the Strait of Hormuz, I'm just wondering if you've had more inquiries about your products because of that.
Yeah, definitely on that front, but I'd really take it back kind of to 2022 when the Nord Stream pipeline was sabotaged and you had the Ukraine-Russia war start. So geopolitically around the world, there's a number of, we'll call them hotspots, and as it relates to maritime security, our technologies are seeing quite considerable demand on that front. Strait of Hormuz, the real challenge there is underwater mines, and our technology was developed when the company was first started specifically for mine hunting applications. So we are one of probably 3 or 4 companies in the world that have this type of capability, and the trends that you're talking about on the news are beneficial to the business for sure.
We know a lot of countries are increasing spending on defense. Ottawa's one of them, of course. They're going heavily into defense, especially in the Arctic. Do you already have contracts with the federal government? Do you anticipate new ones as a result of this push in investment?
Yeah, we do have some contracts with the Canadian government for the Canadian Navy. Yes, we expect more business as a result of the increasing defense spend that we're seeing in Canada. But that's also something that's being copied in other NATO countries, Asia-Pacific allied countries as well. There's an increasing focus on maritime security applications, and as a result of that, we're seeing that same development happening. And one other area that is changing, and you've heard about it on the Canadian government side, is the attempt to change how governments buy equipment. So to start to use dual-use technologies, maybe some technologies that were developed in the non-defense space, and get those in the hands of various navies and armies and air forces from companies that can deliver and help those armed forces move quicker and get lower cost equipment as well, as opposed to spending a decade getting exquisite assets and spending tens of billions of dollars. There's commercially available solutions out there today from companies like ourselves or some of our competitors that can fit the needs of some of the armed forces today.
So, Greg, with a focus on the Arctic, I'm wondering if that area of the world poses any specific challenges for your equipment.
Not really. Yeah, we've operated in all geographies, whether it's in the Mediterranean or the Middle East, where the temperatures and the water temperatures are warmer, into the Arctic as well. Our company is about 14 years old now, and we were on a Franklin expedition back in, I think it was the 2014 timeframe, where our sensor technology were used on underwater vehicles. So no, that's we're used to operating in a variety of harsh environments, and the Arctic's no different.
You're currently on the TSX Venture Exchange. Tell us about the plan to move to the TSX.
It is in the works. We get asked that question quite a bit. I characterize it as, if it wasn't for this Covelia acquisition, we would already be there. We believe we pass all the tests in terms of the financial metrics required to be on the TSX. So we're really focused now on closing this acquisition of Covelia here in Q2. And as a result, in the second half of this year, we'd expect that we'd be on the TSX.
Greg Reid of Kraken Robotics. Up next, the latest data on Canadian travel trends indicates that Canadians are still avoiding the U.S. That's ahead. rising jet fuel costs have been pushing up the price of airline tickets, and also some carriers, including Transat and Air Canada, are actually cancelling flights. So some people are rethinking their summer travel plans. Meanwhile, new data indicate that Canadians are still avoiding the U.S. Let's get more from CTV's Camille Caramali. Thanks very much indeed for joining us. Start off with the effect of these higher jet fuel prices, please, Camille.
Yeah, Andrew, I'm one of those people who is heavily reconsidering the summer travel plans. We have a trip coming up to Europe and just holding our breath to see if some of those flights will be canceled. Look, Air Transat, the latest Canadian airline, to now say it is going to scale back the number of flights it has and functions throughout the summer months, all the way up till October. It is cutting roughly 1,000 flights from May to October. And it says those are mostly short-haul flights where they don't get as much traffic and passengers signing up for them. It accounts for about 6% of its flights. It says it'll have fewer flights going to Europe and the Caribbean. But earlier, German airline Lufthansa said it would be canceling 20,000 flights across Europe. These Lufthansa cancellations are primarily short-haul flights that go on until October. Now, I heard you there. It sounds like a big number, but Lufthansa saying it is a single digits, maybe 1-2% in terms of how many flights it runs, because it is such a massive global airline. But plenty of other Canadian airlines, Andrew, also speaking up, saying that they are scaling back or adding fuel surcharges because of the situation in the Strait of Hormuz, the Iran-U.S. war, with Iran blocking that strait that accounts for about 1/5 of the world's oil and the resources used to provide jet fuel for so many European airlines. So as long as that situation continues, flights will continue to be canceled, especially by European airlines.
Camille, sorry, we've only 30 seconds, but Canadians still avoiding travel to the U.S.?
Yeah, Statistics Canada, I'll try to summarize it very quickly. Statistics Canada saying, Andrew, that for the numbers we're seeing in February, it still shows that Canadians are boycotting the U.S., still traveling to other overseas destinations. U.S. travel by Canadians in February of this year down by 12.5% compared to February of last year. But February, you'll remember the Strait of Hormuz was still open, so it'll be really interesting to see March's numbers to see whether people are scaling back on that overseas travel and maybe choosing to go to the United States, where airlines and flights will still be a little bit more dependable. So we'll have to wait until March's numbers to find out.
Thanks a million, Camille Caramali, our colleague at CTV News. We have the opening bells next. There it is, the opening bells on Bay Street and Wall Street at the NASDAQ. Roku, the provider of streaming for consumers, doing the honors. In New York, it's L3Harris Technologies, the big defense contractor, ringing the opening bell. Yes, in Toronto, it's the FIFA World Cup 2026. Opening the market. I'm expecting my deluxe VIP tickets into the games in the mail anytime soon. It is time for the first 15. Trading getting underway. Let's check in on the equity markets. They are down because we're getting ongoing harassment of ships in the Persian Gulf region. As I mentioned, U.S. President Donald Trump telling the U.S. Navy to shoot boats placing mines in the Hormuz Strait. The Americans have been intercepting Iran oil supertankers. They intercepted 2 of these giant ships that apparently tried to evade the blockade. And so far, they've been directing vessels to turn around and return to port. So there's still a cutoff of that vital oil artery. Let's have a look at some stocks of interest. Tech, of course, it's in the process of being taken over by Anglo American, but a surge in revenue at that company. It warned of higher fuel costs for its flagship Chilean copper mines with this rise in oil prices. There could be an amplified effect on costs at our Chile operations, and first quarter so-called core earnings more than doubling. And let's have another look at one or two of these cannabis stocks, because the Americans, as expected, moving, and there's Tilray jumping, and it soared yesterday as well. The Americans moving to reclassify marijuana as a less dangerous drug. Wall Street Journal argues this is a significant policy shift that could make it much easier to buy and sell the drug. And so we saw Tilray jumping yesterday, I believe. We did see some other cannabis stocks up, and there you have it. But Tilray stock still down more than 80% in the past year. Okay, actually, no. Oh yeah, Tilray was up yesterday, and it's higher again today, pretty sharply higher. Okay, some other stocks of interest here. Pembina, PPL, I believe, is the symbol. Oh, there's Canopy Growth as well, still down, but it's actually ahead over the past year and rallying like the other cannabis stocks. There's Pembina Pipeline. They've struck a deal with the private equity giant Apollo, U.S. Player, in which Apollo will buy a 40% stake in Pembina's gas infrastructure operation. Pembina will go on owning the other 60%. Okay, and so that's interesting. The U.S. private equity buying into Canadian midstream energy. Let's have a look at IBM in early trading. That's the IT services giant. It produced an outlook that analysts see as cautious. The company also reported first quarter results that featured an underwhelming read on its software business. So mixed news there from IBM. And there we have it. So the stock, it has suffered over the past while, down around 9% today. Texas Instruments is on our radar. That producer of devices provided a surprisingly strong forecast, helped by booming spending on data centers and industrial equipment. And Hasbro posted preliminary net revenue for the first quarter that topped estimates. And can we have another quick look at Lulu, because it named a former Nike executive as CEO, but apparently that is not the candidate that had been put forward by activist investor Elliott Investment Management. Meanwhile, Chuck Wilson, the former CEO, Chip Wilson, is maintaining a proxy fight. He wants new faces on the board. Coming up, insights on the market and a look at what's driving healthcare stocks. Stick with us. Hopes for a near-term resolution to the conflict in the Persian Gulf are dimming. Traffic through the Strait of Hormuz still largely stalled. We are seeing some selling today. Let's have a look, though, at a sector, or we'll focus on the broad market, but we'll also look at that healthcare sector, which is traditionally seen as defensive. People still get sick. Doctors still send in bills. We're joined by Paul McDonald, President and Co-Chief Investment Officer at Harvest ETFs. Great to see you, and thanks very much indeed.
Nice to see you as well, Andy.
Before we talk about healthcare, how are you positioning yourselves in the broad market?
Well, look, I think first and foremost, there's reasons to be optimistic here. And, the Bears have had control of the microphone, call it, over the past month or so, and for good reason. There's a lot of known unknowns about the outcome of the war, its implications for the broader markets. But when we take a step back and say, hey, do you know what? The market actually was consolidating in through November, December, and in through February, and we actually saw a lot of signs of positivity, and the breadth of the market was expanding. And so I think first and foremost, there's reasons to be positive in the market, and the market's telling us that. I mean, we're within a couple percent of all-time highs here, despite the relatively negative narrative out there. So, but I don't want to be naive to that known unknown, which is what is the duration and the ultimate implications of the Mideast war, and that's going to likely remain an unknown, at least over the near term. So as we kind of navigate this, cloudy or even foggy macro environment, I think our view really hasn't changed since we've been in this consolidation mode, which is be invested. You have to have some defensive areas. Utilities are still working, for example, but these opportunities, when we see growth and that AI infrastructure build out, is unequivocally not going away. We see it with Texas Instruments this morning and some of the others reporting. There's reasons to be optimistic, and I think the earnings season is starting to at least give us some early indications of that as well.
So tell us about one of your ETFs here. It's the Harvest Healthcare Leaders Income ETF. And this is one of those guys that uses options to produce a bigger yield?
That's right. So covered call, 20 large cap healthcare stocks. It's been around for 10 plus years, same distribution, actually increased it. And look, when we think about the world and where we want to be allocated, we really see it as a barbell strategy. Again, having that defensive areas, and I'll touch on healthcare, as you pointed out. We think having that tech exposure and having that growth, which is the leadership area coming into this, correction that we had in through March, but also has been the leadership coming out of it. So having tech exposure makes a lot of sense. Healthcare has been and was performing quite well up until this latest pullback, and it's been a real challenging environment. I would say for the past 18 months, it's been in a consolidation. It should be acting more defensively, but there have been some headwinds that, whether it's in managed care and some of the policy initiatives that kind of have kept it at bay. And so we're starting to see some earnings season through this earnings season, some real strong upside surprises. And I think that's healthy. We're looking for green shoots in the sector. Give us a sign that we're in that bottoming process. And we're seeing some early signs. So the one thing that's not going to go away from broader market or in healthcare is volatility. So that option strategy does help us monetize some of this volatility that we're seeing in the market.
I'm just looking at Bloomberg numbers on the 5-year return from this ETF. It is down 14% apparently in terms of actual capital gains or capital losses, but the dividend has kept your return in line with the MSCI World Healthcare Index or the S&P healthcare sector at a 5-year return of around 30%. So the income has kept you on side, even though the actual price of the holdings has dropped.
That's right. Look, and typically in environments when returns are harder to come by, those option strategies really do become a more meaningful component of total return. And so absolutely, 10 plus years of history of distributions, and that's been very much additive to that total return. And so not just within healthcare, but we also see that across other segments of the market right now, where monetizing this volatility, premiums from option strategies are very high, and we see that as an opportunity, or effectively, people say you must love volatility. Well, love's a strong word. We like it, and so here's a way to monetize some of this volatility that we're seeing.
It's interesting. A pretty focused portfolio. 20 giant global healthcare companies.
That's right, 20, and it's 20 consistently. And the turnover for us we've got a couple name changes we're looking at, but relatively low. We really want to be diversified within our healthcare space because, quite frankly, the science can change almost instantly and have lateral or impacts to one company that may be positive for another company. And so diversity, not just across the individual subsectors, but looking underneath the surface to make sure we're exposed to all the areas that we think have the most growth potential.
It's interesting. I see you have a heavy emphasis, though, on the pharma companies. The latest top holdings I have from March 31st, AstraZeneca, Merck, AbbVie, Johnson & Johnson, Amgen. So you don't have the big U.S. health insurers among the top holdings, for example?
So we're equally weighted, and it's a great point. So that skew is just because of the relative performance in the underlying stocks. And what's interesting, Andy, is that if you had have asked me at the start of the year, what are your best performing stocks going to be this year, I would have said, in December, most likely companies like Intuitive Surgical, Boston Scientific, some of my med tech growth that really that have been participating in that whole growth factor trade as well. And ironically, though, as you pointed out, the weights in our pharmaceuticals are skewed because some of our best performers have been AstraZeneca, Johnson & Johnson, and really highlighting, and for no particular reason other than I think a bit of a style shift within the market itself and within the sector. So that diversity within the sector is exceptionally important.
Thank you very much indeed, Paul. Paul McDonald, President and Co-Chief Investment Officer at Harvest ETFs. Coming up, Tesla is facing a class action lawsuit from disgruntled drivers over its decade-old full self-driving promise. Now it's spending $25 billion US on robo-taxis and humanoid robots. Will investors buy into that promise? That's up after the break. Tesla plans a huge boost in capital spending this year to more than $25 billion. And it's betting big on autonomous vehicles and humanoid robots. Meanwhile, though, the company is facing a class action lawsuit from dissatisfied drivers over the delay in delivering full self-driving features. Will investors be happy with this ambitious spending plan? Let's start off with that. We're joined by Seth Goldstein, Senior Equity Analyst in Resources and Chair of the Electric Vehicle Committee at Morningstar. Thank you very much indeed for joining us, Seth. It's great to hear from you. Your thesis here, I believe, is that you need to have faith in Elon to go along with this. He has pulled off marvels in the past.
That's right. Tesla is going through a big transformation for the company where they aim to go from being a car maker and battery maker as their primary businesses to focusing on cars that can drive themselves and the autonomous software needed to do so, both for robotaxis and personal vehicles and ultimately humanoid robots. And so to do this, Tesla needs to spend a lot of money in artificial intelligence and to develop its software to have the data centers, the infrastructure needed to run these platforms. And so they're undergoing a big capital spend right now, similar to what we're seeing across many tech companies that are investing heavily in AI. And yet this is going to be a longer payoff. And so I think we see the stock is down today because investors are reacting to the capital expenditures being raised $5 billion for the year.
And one point observers are making is that, sure, Amazon might spend tens of billions of dollars on AI, but it has massive cash flow from Amazon Web Services, for example.
Yeah, that's true. And I think part of the reason we're seeing the stock sell off as well is not just the CapEx raise, but the note from Tesla's management that we're going to see negative free cash flow for the rest of the year. And so that means we're going to have to see Tesla's large cash balance start to fund their AI growth plans. And, I think it's going to be a concern hanging over the stock until they can prove that they can generate positive free cash flow again and through this investment cycle. So 2026 looks like we're going to see 3 quarters of negative free cash flow. We'll see what happens in 2027 if they can start to grow deliveries, if they can grow the battery business, if they can grow the Tesla robotaxi business to the point where we start to see a little more self-funding and less of a cash balance drain.
The Wall Street Journal talked to a fellow called Tom LoSavio, a retired attorney and also a bit of a self-driving nut, or certainly an early adopter of Tesla. And he has joined a class action lawsuit saying we bought into technology on this promise of self-driving, but Tesla has not delivered.
Yeah, I think it's going to be a concern for many of the early adopters who thought that they would have a car that was driving them, that would be driving itself right now. And Tesla is making progress, and the software is taking over more and more functions. And for many consumers and drivers, they just have to press the button and really don't have to do anything but just monitor the vehicle for most of their commute. But ultimately, I think you see some early adopters are frustrated that it's taking so long, and the consumers who have the older hardware in Teslas that have to run an older version of the software are getting a not what they hoped for. But I think ultimately this will likely be resolved. I know in the past management has talked about exchanging the hardware, so essentially upgrading to the hardware 4 from the hardware 3 platform, which then would allow many of those drivers who paid for full self-driving to enjoy the latest and greatest version.
So let's have another look at Tesla. Maybe over the past 10 years, is Tesla cheap right now, or where is it relative to your valuation at Morningstar?
But we have a fair value estimate of $400. And so with the stock trading about 5% below that, we don't think it's necessarily cheap. It's still in 3-star territory. We would need to see a larger margin of safety, about 20% below, so in the 320 range, before we would start to think shares are really cheap here, because we have a very high uncertainty rating on the stock. We see a wide range of outcomes for Tesla, given their very ambitious plan to transform the company from cars and batteries into AI and robots. We do think that carries a wide range of outcomes. They could certainly be very successful, but there's also a scenario where they're not successful, or they see increased competition, and that would lead to a lower valuation. And so, we'd want to see a larger margin of safety versus where the current price is relative to our $400 valuation before we think that shares would be a buy and would look cheap enough.
Thank you very much. I really appreciate it, Seth. Seth Goldstein, Senior Equity Analyst at Morningstar Equity Research. We have lots more on the show. Trade tensions between Canada and the U.S. continue to escalate. We'll have more on that after the break. Looks like Canada and the U.S. are bristling at each other over trade. There have been jabs by the U.S. Commerce Secretary, Howard Lutnick, and the U.S. Trade Representative, Jameson Greer. And then the latest from Canada is the ambassador, our ambassador to the U.S., is slated to make his first address to parliamentarians to discuss his mandate at the Standing Committee on Foreign Affairs and International Development. So there's plenty happening. We are expecting a statement as well from the Prime Minister. Let's round this all up. We're joined by Jeremy Sharon. Jeremy, thanks very much. So take it away, please. But there's a kind of a war of words going on between the two parties.
Yeah, that's exactly it, Andy. Ahead of this July 1st deadline, a deadline to review the CUSMA agreement, the Canada-U.S.-Mexico agreement between the three countries, there is tension right now. There is a bit of a war of words, as you've touched on. Commerce Secretary Howard Lutnick, in a Senate hearing yesterday, was quite clear that he has things that are irritating him when it comes to the trade deal right now between Canada and the U.S., specifically when talking about U.S. spirits and the fact Canada and provinces are keeping U.S. spirits off the shelves right now. He said that it is outrageous and insulting that that is the way Canada is handling this right now. So, the U.S. administration has been quite clear. That is an irritant to them pretty clearly. They are upset by the fact that U.S. alcohol is being kept off Canadian shelves. They have been very clear and very outspoken about the fact they are against what is happening in the dairy industry and Canada's supply management system, despite the fact, the current agreement as it stands is the one they agreed to when the Canada-U.S.-Mexico agreement was signed under U.S. President Donald Trump. That being said, they have been clear They would like to see changes. They believe that U.S. dairy farmers are being treated unfairly as a result of supply management, which of course allows only limited access to the Canadian market for U.S. dairy farmers. The other thing that they have outlined as an irritant is the Online Streaming Act, which puts streaming giants like Netflix under the same set of guidelines and rules as traditional broadcasters under the CRTC. So they have certain rules to adhere to. They have to promote a certain amount of Canadian content. They have to follow all the same rules, and the U.S. administration doesn't like that. I suspect we'll continue to hear about all of those irritants. They have other complaints as well. What we heard from the Prime Minister yesterday is that Canada has its own complaints, things that they are irritated by, and that they've made that clear to the U.S. administration, and that they'll continue to go back and forth and use official channels to continue negotiations. But the Prime Minister made a point yesterday to say that the U.S. will not dictate the terms of negotiations just as a result of the things they don't like right now in the deal. So to your point, Andy, we'll hear from the Prime Minister a little bit later today. He is set to make some kind of announcement where he'll likely also face questions about trade. And we'll also hear later today from Mark Wiseman for the first time, the Canadian ambassador to the U.S., who will be speaking to a Foreign Affairs Committee here in Ottawa, addressing parliamentarians. He'll likely have significant insight to share as to how conversations are going so far. He will play a key role in negotiations ahead of July 1st, so I think we should be able to learn a lot from Mr. Wiseman a little later today.
Jeremy, thanks very much indeed.
Yeah, of course, anytime.
Really appreciate it, Jeremy Sharon, our colleague at CTV News. We've lots more ahead. Tech Resources posting a big jump in first quarter profit. We'll get reaction after the break. Welcome to the second hour of the Open. Let's check out those big stories we're bringing you from our newsroom. Another look at shares in Lululemon, down 9%. The company has said that former Nike executive Heidi O'Neill will take over as CEO. O'Neill spent more than 2 decades at Nike and is set to step into the role in September. Lulu has been struggling with weak sales and rising competition. The Elliott Investment Management has been pushing another executive to take over as CEO, so that may be a part of the disappointment here. And shares in Tesla came under pressure. The company beat on profit expectations, but says its capital spending will top $25 billion US this year, well ahead of expectations. The company's ramping up investment in AI, humanoid robotics, and its cybercab platform. Elon Musk, the CEO, says the heavier spending is meant to set the stage for much larger vehicle production. And Tech Resources posted first quarter profit that more than doubled from a year ago. The miner also posted revenue that was ahead of expectations, coming in at nearly $4 billion. The company says the quarter was driven by higher copper sales. The result comes as the company continues to work towards its takeover by Anglo American. And there is a very quick look at the TSX. It's down slightly in morning trading. This ongoing turmoil and boarding or diversion of ships in the Persian Gulf hanging over the market. Let's have a quick look at the U.S. markets to see how they are faring. They too under a little bit of pressure today, but near record highs, as is the TSX, are not far off. So far this year, the S&P is up about 4.2%. Toronto is up about 7%. So investors liked the numbers from Teck Resources, but the company did warn of higher fuel costs at its huge Chilean copper mines. We're joined by Colin Shazinski, Portfolio Manager and Chief Market Strategist at SIA Wealth Management. Colin, thanks very much indeed for joining us.
My pleasure. Thanks for having me, Andy.
I'm not sure if you can help me with this, and I'm trying to get my head around it. Why would Teck be up today? Isn't it just trading on the takeover by Anglo-American?
It seems to me that from time to time, Teck is trading off of other things. And mostly, yes. I mean, you would expect that a company that's involved in a big merger, and even though the shareholders have approved the merger, they still have to wait on regulatory approvals. But I guess on the interim, because the regulatory approvals might take a year, in the shorter term, some people are still trading it off of commodity prices and off of earnings reports as well.
Right, and certainly quite the move up in the stock. Some other stocks that are on our radar today, investors not loving the news from IBM.
No, it's actually an interesting day for earnings, and important. We're now getting into the heart of earnings season. A lot of companies are reporting, and we're getting mixed reactions. So I'm looking at technology today, and two tech stocks I'm looking at in particular, IBM and Texas Instruments. And IBM is down 10%, even though it beat on earnings, but Texas Instruments is up 16%, beating on earnings. So it just depends sometimes. A lot of times it comes down to the press conference, what management say about in terms of guidance, or if there's anything small that isn't necessarily turning up in the headline numbers.
Right, Texas Instruments. Wow, that stock almost a double in the past year. What are your thoughts on Tesla? It's a I don't know, concept stock, it's not a meme stock, it has a real business, but in a way you're betting on the Elon Musk halo, aren't you?
To a certain extent, yeah, and I mean that's always been the case that Tesla tends to trade a lot off of that, and a lot off of sentiment and feelings, because its valuation compared to other car companies is astronomical, and has been in historically for many years now. So it is more of a sentiment-driven stock, and what is interesting is that even among the large cap Magnificent Seven stocks, it's one of the weaker performers, and has been for some time now.
Yeah, would you put money or clients' money into Tesla right now, Colin?
No, we look at stocks on a relative strength basis, and we focus investments in the companies that are outperforming and have the highest rankings, and the ones that are lower in the rankings we tend to avoid and wait until they come back and show some strength. So right now, Tesla is down in the lower half in the red zone, so it's a stock that we're not really looking at right now.
Right. Actually, just to loop back to Teck Resources, I'm checking Anglo-American stock is up around 5% in London. So that's probably helping to lift Teck in that it's increasing the value in theory of the merged company.
Absolutely, and in terms of Teck and its relative strength, it's been doing really well. It's within the Canadian investment universe. It's in the top 25%, the green zone, and it's been steadily climbing for some time now. So even before the numbers came out, Teck has been outperforming.
Apparently, investors are happy to hear that Anglo-American has at least 3 possible buyers for its Australian steelmaking coal operations, because the deal to sell them to Peabody fell apart. How are you buying airline stocks at all these days, Colin? American Airlines or Southwest, on the threat of higher fuel prices?
It's a funny thing. We've been watching for the economic data and the earnings data coming out since, as now we're starting to get numbers from since the start of the war. And what's interesting is the broad economic data, especially for North America, has generally held up. Europe's been a bit soft, and then so now we're watching to see, well, what do the companies have to say? And it seems as though the economy itself is relatively robust, but now we're starting to see signs, though, that higher fuel costs are starting to creep into the system. You mentioned it with Teck Resources, and both of the airlines that reported today have anyways, both of the airlines that reported today, they put out better than expected, decent results, but they both said fuel costs are rising and they cut their guidance. So that, I think, is something we're going to see much wider. I'm sorry, what I was trying to find was that generally speaking today so far, American Airlines is actually up because their losses were less than the street expected, and Southwest Airlines is down because its earnings were less than expected. So, but as we move forward, even when the economy is robust, it looks like inflation is starting to creep in.
Yeah, it's fascinating. You know, we hear about it, we forget how giant the airline industry is. Transat announcing cuts yesterday, but it's still only about 6% of their capacity. And even though in Europe, Lufthansa is cancelling a whole bunch of flights, it's still only a rounding error. So there may be a lot more to come in these flight cancellations. Colin, give us your thoughts on the next couple of weeks. I know it depends on diplomacy and possible talks between the U.S. and Iran, but is there anything investors are missing here or anything they should watch out for?
The big thing that I'm now focusing on for the next couple of weeks is earnings. It seems as though with the war, it's kind of settled down where we've had these humongous swings for a long period of time while people tried to figure out what was going on and set their expectations. And we've seen a lot of capital rotation in and out of different sectors. And that seems to be settling down. Investors now seem to be much more focused on earnings. And over the next 2-3 weeks, we're in the heart of earnings season, hundreds of companies reporting on both sides of the border. All the big cap companies, pretty much, with a few exceptions, are reporting results. So I think we're really going to see a focus on earnings. And today was one of those first days where we've had a lot of big name companies report. And so far, the results have been mixed. We've seen some things go up quite a bit. We've seen some things go down quite a bit, even within the same sector. We've seen that in tech. We're seeing that in airlines. And so it's something we want to be watchful for and mindful of especially over the next 2-3 weeks as we move through the heart of earnings season.
Colin, thank you very much. Colin Shazinski, Portfolio Manager and Chief Market Strategist at SIA Wealth Management. Coming up, we're going to tell you about a multi-billion-dollar possible opportunity. Excuse me, that one Canadian private investment firm sees in Toronto's distressed condo market. We'll be right back. After a multi-decade building boom, Toronto has a condo problem. Developers are stuck with a record number of empty units. Let's get more from Bloomberg Canadian wealth reporter Ari Alstetter. Ari, distressed assets tend to attract buyers ultimately, and one fund wants to spend maybe $1 billion buying up these unwanted condos.
Yes, it took some time in Toronto. You know, the real estate market, by most measures, peaked in early 2022 and has just been sort of sliding down ever since. But it seems finally we're seeing some real institutional interest in Toronto's condo sector in the form of a new private investor money manager called High Art Capital, which is plans to raise up to $1.3 billion, although fundraising may prove greater than that, to buy up these distressed condos from developers that have just been kind of piling up, sitting empty in Toronto, and to take them and rent them out instead.
It's really intriguing because obviously these buildings are collectively owned, and so empty condos in a building, I guess, mean that the people who actually are living there are paying higher management fees or might be at risk of that.
You're right. It could have impact on the people who actually live in the condos neighboring these empty units. Because generally how the condo business works is a developer, when they launch a new project, they pre-sell a certain number of units to investors who either want to live in them upon completion or rent them out. But then the developer also keeps a certain portion of the units back to sell at completion. The trouble in Toronto has been that as these these buildings have been completed, developers haven't been selling the units they kept for themselves, and nor have they been renting them out. They don't like the prices they could get from selling them in the market, and there's considerable costs for a developer to try to rent out a unit themselves. They're not really rental companies. They don't really know how to do that, and so they've been sort of sitting on them instead. And these empty units have just been building up. Which, of course, you're right. The people who bought the other units pre-sale might be living them, might be renting them out themselves. That has an impact on them too. So it's in their interest to some degree to have these units sold rather than sitting empty in the developer's possession.
I suppose, though, if you own a unit, you're still on the hook for the management fee, the maintenance and stuff. So, but it can't be good, though, having just these dead units sitting there. So the Ontario government, you may have touched on this, is putting up as much as $300 million to help the idea is rejuvenating housing construction.
Yes, that's really key to what got this fund off the ground. It was a sort of seed money in the form of $300 million loan, mezzanine loan from the Ontario government's Building Ontario Fund. And private capital has sort of been circling the Toronto condo market for some time. There's been some smaller deals by sort of family offices or really wealthy individuals for these bulk condos, but we haven't really seen any big fund get in on the act. And it seemed like the Ontario government's investment here really helped get things moving in this case, because it allows the fund then in turn to offer more favorable returns to the $1 billion plus in private capital it's looking to attract, which hasn't really, that kind of money hasn't really come into the market yet. But the fund, when I spoke to them, said that the fundraising has been good and they expect to raise everything that they're targeting and be able to start closing on units soon.
That's a fascinating story, Ari. Thanks very much.
Thank you.
Ari Alstetter, who is Bloomberg's Canadian wealth reporter. Coming up, we've got the ETF report. Middle East oil flows have been disrupted and fertilizer supplies have been squeezed. We are going to talk about ETF plays, potential picks for investors looking to play a world in conflict. That's ahead. Time for the ETF report. War in the Middle East has been reshaping the commodity landscape. Oil supplies have tightened and fertilizer prices have jumped because so much nitrogen fertilizer comes out of the Gulf and some refiners are cashing in. Our guest is watching and he's involved in the ETF industry. He's got his eye on oil, agriculture and energy refiners. We're joined now by Sal Gilberty, founder and CEO of Teucrium. Sal, great to talk to you once again.
Good morning. Always happy to be here.
Let's jump into it. USO is probably the best known ETF for directly playing the oil price. Walk us through what you're buying if you buy USO.
Sure. And again, I'm not making recommendations. No. I'm just giving, I'm talking about the funds. People can make their own decisions. But USO, along with BNO is the Brent crude oil ETF. USO is the U.S. crude oil ETF. Right now, we're losing, depending on estimates, if you use the EIA's estimate, we're losing about 6 million barrels a day of oil, crude oil that's available to the markets. So that production isn't happening, mostly in the Middle East. If you net everything out, the U.S. is making up for some of that. Others are too. When you net everything out, we're losing about 6 million barrels a day of supply. And it looks like demand is contracting, but not nearly as much as supply. And so this whole situation is building a crude oil deficit around the world. We're drawing from supplies. Our base stock levels that we're accustomed to working with are going lower. It's going to take quite a while, even if the war ends today, to refill all that. So crude oil has some really seriously bullish fundamentals, and I think that the market may even be underpriced right now because every single day that goes by that the straits are blocked and there isn't a free flow of oil from the Middle East, we're cumulatively adding to the deficit, which is about 6 million barrels a day, and that's really big.
I'm just looking at Bloomberg's take on USO here, and it has that ETF up 93% in the past year. So it's been a lucrative play on oil.
It has, and I would caution people who invest in these that it's a short-term play. It's again, oil fundamentals are very friendly right now, but if the war ends, they will correct and contract. There's going to be a lot of volatility in those. So, you know, playing USO or BNO or whatever oil ETF you choose, it's a dangerous game, and so people should be aware of that, and they're going to experience some volatility.
Right. Let's talk about one of your funds now. It's TILL, T-I-L-L. Tell us about that one. It's the Teucrium Agricultural Strategy ETF, and it's about gaining long-only exposure to corn, wheat, soybeans, and sugar. I think it's those four commodities.
That's right. It's the big four: corn, soybeans, wheat, and sugar. And if you look at the global picture of grains right now, first off, grains are very low correlation to the stock market. So if you're looking for some safe haven or something that will diversify your portfolio and kind of cut the volatility in it, grains have traditionally been very effective at doing that. If you look at the cost of corn, the big one in there, well, they're all 25% weighted, but the big commodity of corn is king, as they say. We're very near the break-even price of corn. Last year, on a per bushel basis, corn only traded in futures in the United States for 2 days under $4 a bushel. That would indicate that the production price of corn is at least the futures equivalent of $4. You're at about $4.50 right now, which means you're within 10-12% of last year's break-even. And very importantly, break-even costs are rising because of high energy prices and now because of high fertilizer prices. Much of the natural gas, liquid natural gas that's exported from the Middle East is used to make synthetic fertilizer, and that has been disrupted. So the price of fertilizers has gone up. Corn is a very fertilizer-intensive crop, as is wheat, as is sugar. And so those three crops need the fertilizer that right now the supplies are adequate, but we're in planting season. We're just entering the global planting season. You're seeing a price shock in fertilizer to farmers. So it's likely that farmers are going to use less fertilizer. That's likely to reduce yields globally. That's a big deal for corn, which is very nitrogen heavy, fertilizer heavy. It's a big deal for wheat because you produce wheat all around the world. And a lot of countries are not going to, farmers in those countries are not going to be able to afford to use at least as much fertilizer as they ordinarily would. Sugar is at its 5-year low, price low right now. Supplies of all these things are adequate, but we're going into the new growing seasons. And so looking at grains and seeing that they're within 10 to 20% of their cost of production, depending on which one you're looking at, that prices are the cost of production is much higher than it was last year. Grains are something to look at, which could potentially stabilize your portfolio. And if there's any weather disruption or any further price increase or disruption in the supply of fertilizers, we could be experiencing some problems on a farm level. Biofuel demand is really big, and so that's for soybeans. And so those four are at pretty historically stable price levels. They're not stretched in any way in terms of pricing, and they are something to look at, especially given the cost of energy and fertilizer that doesn't seem to be abating and probably won't near term.
Thank you very much, Sal, as ever. Sal Gilberty, founder and CEO at Teucrium. Up next, we've got the headlines. We're going to update you on the markets. And then, could Texas be the next major player in global markets and a potential rival to the NYSE, NASDAQ, or even the TSX? That's next. Welcome back. Let's get to the big stories that are moving the markets right now. The U.S. Justice Department reclassifying state-regulated cannabis as a less dangerous drug. So this has moved licensed marijuana products from so-called Schedule 1 to the less strictly controlled Schedule 3. It does stop short of fully legalizing the drug for recreational use, but it meets the demands of many advocates who have long argued for looser restrictions. Another look at shares in Lululemon. Wow, taking a pounding, down 12%. The company has announced former Nike executive Heidi O'Neill as the new CEO. O'Neill spent more than 20 years at Nike. She takes over in September. The company has been struggling with weak sales, rising competition, and a recent sizing controversy. Elliott Investment Management has been pushing for changes, and it wanted to see another CEO installed. Shares in Lockheed Martin slipping after the company missed profit estimates in its latest quarter. That was driven by weak production performance, including delays on the F-16 fighter jet program and delivery delays on the C-130 transport aircraft. However, the company is sticking with its 2026 forecast, pointing to new U.S. government contracts. There's a look at North American markets. Toronto now in positive territory. We did see, remember, in early trading, a slight rally in oil. That always is good for our market. The heavy traders right now in Toronto include the banks, Bank of Montreal, Royal Bank, both moving higher. Shopify is down a little bit, and Celestica pushing further into a record territory, helping to support our market. U.S. stocks slipping. A few shares of interest in Toronto. I'm seeing selling in Constellation Software, and I haven't seen any particular reason for it. That stock down about 6% today. And of course, there are worries that that traditional software business that it operates in is going to be hollowed out by AI. So I haven't seen any particular developments there, but we'll be keeping an eye on that one. Savaria, the maker of mobility devices, vehicle modifications, a play on an aging population, that stock hitting a record high. We just talked to the CEO not long ago. You can find that interview on bnnbloomberg.ca. And QSR, the fast food operator, trading near record highs. Right now, it may even be there. Investors are buying into a thesis that the company is improving operations at Burger King. A new stock exchange is opening in Texas, with its IPO expected in early 2027. Bloomberg sat down and talked to the former U.S. representative, who is now an advisor to the Texas Stock Exchange. He spoke with Bloomberg's Texas Bureau Chief, Julie Fine. Let's have a listen.
Chairman, we appreciate you being with us today. Thanks so much.
Good to be here.
Senior Strategic Advisor to the Texas Stock Exchange. When do you expect trading to start?
So we expect trading to start this summer, and shortly thereafter, you will see listings probably in Q4 of this year, and then Q1 of next year will be IPOs. So there's a lot of exciting momentum at the Texas Stock Exchange. We're on track, and again, this is going to be revolutionary to our public markets.
So late this summer, you think?
We'll go mid to late.
Mid to late this summer. Okay, that's pretty close.
Well, and since last I was here, we've had a lot of progress, a lot of momentum. Our trading engine has been completed. It has been tested. It will be world class. You know, there's about 8 or 9 people who have the experience and credentials to create that engine, and most of them have come to Texi. So we're excited about that. A lot of changes since last I spoke to you.
Yeah, let's talk a little bit about IPOs. When do you see that happening on the Texas Stock Exchange?
Well, again, we would expect that to be in Q1 of next year. But already, as you may have seen, we have momentum in listings. We in the ETP space. We've had the first announcements of those that will list on the Texas Stock Exchange, including 2 funds by Cathie Wood's ARK. So this is a lot of validation from the market and a lot of momentum.
How about permanent headquarters in Dallas? That has not yet been announced. And obviously, if you're going to be doing trading, you're going to need your permanent headquarters. When do you expect that to come?
News to come soon.
How soon is soon?
News to come soon.
Okay. All right. Well, all of this is going on. You just took a trip to Florida to promote what you're now calling the Boom Belt, 11 southern states you view as business friendly. How does this play into the Texas Stock Exchange specifically?
Well, Julie, I think that, again, what we have seen is a big push-pull dynamic when it comes to finance in the U.S., when it comes to the economy, and particularly when you look at Texas and Florida and Georgia and Tennessee, you have this net migration of people, you have this net migration of wealth, you have all kinds of economic activity coming really to this part of the U.S. And so we believe that that's the kind of the first natural market to be trading, listing on the Texas Stock Exchange. And so we wanted to highlight that with Governor DeSantis and with Governor Abbott, with a bunch of CEOs who are interested eventually in both trading and listing on the Texas Stock Exchange. But again, it just speaks to how the economic center of gravity is coming to a different portion of the U.S. and to Texas in specific.
So when you discuss this boom belt, obviously these 11 states may be competing for business with each other.
Well, there is a friendly rivalry, especially between the 2 governors. And Governor DeSantis is somebody I served with in the House and I know well, and Governor Abbott and I go way back. So I know between the 2 of them, yes, there is a friendly competitive rivalry, and that only helps with economic growth for kind of this boom belt, the southeast quadrant of the U.S. In general. That competition is good for the economy. It's good for retail investors as well.
Speaking of competition, now you have the New York Stock Exchange Texas and NASDAQ Texas. They have much larger profiles here than they did with the Texas Stock Exchange.
Well, I must admit, it's kind of ironic. As you know, we've been around since 1836, and until the formation of the Texas Stock Exchange, they didn't bother to put any kind of presence in the state of Texas. Now they have, and so I think it's good for the state of Texas. We like competition. But the truth is, I mean, these are great companies. NASDAQ and New York Stock Exchange, they're great companies. They're just not necessarily great exchanges for retail investors. They're not great exchanges for issuers. So I'd love to own stock, for example, in NASDAQ, but I wouldn't want to list on them. There is a reason why so many market participants want to be a part of Texi. And since last you and I visited, we've had another capital raise, and now we're up to almost $300 million. And, you know, that's BlackRock, that's Citadel, and now it's JP Morgan, now it's Goldman. They believe that there is a place and a need for another stock exchange to compete with the duopoly. And then, as I mentioned earlier, now we have our first listings that have been announced, including, again, 2 from ARK. This is big. And then last but not least, another validation point between us and the competition. Jim Lee, our CEO, he is a great coach, and he's taken advantage of the transfer portal. We've got all kinds of talent that has come in from SIBO, from New York, and from NASDAQ. And they're coming to the Texas Stock Exchange. The transfer portal's not going the other direction.
And you talk about large companies with Texas Stock Exchange, but it is important to note here, you're talking about people dual listings at this point. It's not like they're saying, okay, we're throwing all in on this, dual listings.
Well, it is dual listings. And the point I'd make about that is, dual listings is something that the New York Stock Exchange used to sell, and then they started to give it away for free once they, put their long-standing Chicago market medallion in a Federal Express envelope and sent it to Texas.
I'm sure they disagree with you on that, but okay.
Well, they may disagree with me on that. So, listen, it's good it's good for Texas. They have finally decided to come here. Again, we welcome the competition, but there's only one exchange that was Texas born, bred, and led, and that's the Texas Stock Exchange.
So our Bloomberg partner is talking to Jeb Hensargling. He's a former member of the U.S. House of Representatives for Texas, now advising the Texas Stock Exchange, well known for his close links to Wall Street and for his donations from the payday lending industry. He spoke with Bloomberg's Texas Bureau Chief, Julie Fine. Coming up, Hot Picks, we're going to dive into 3 REITs. Picks today, we are looking into REITs. Let's say hello to Lauren Kalmar, real estate analyst at Desjardins. Great to see you. Thank you very much indeed for joining us. Lots of buzz, obviously, in the REIT space right now. Your first idea is Primaris, PMZ.UN. What attracts you here?
Yeah, thank you and good morning, Andrew. Thanks for having me on. So I would say Primaris is probably our top pick in the entire space. And for those who don't know, Primaris owns about 30 enclosed malls. Previously, malls had been in the category of persona non grata. And as we've come out of the pandemic, the story around malls has significantly improved. The PMZ has significantly altered the composition of its portfolio via acquisitions, largely of pension fund-owned malls. And ultimately, what you have now is a REIT with a peer-leading organic growth profile and ultimately a peer-leading earnings growth profile. You have a company that has an extensive acquisition opportunity set, significant upside through the sale or monetization of excess density at some of these malls. You've got a REIT with a peer-leading balance sheet. It's got the best balance sheet in our coverage universe. That's on a net debt to EBITDA basis, about 6 times. And I think you've also got a really well-respected, well-rounded management team. And they recently bolstered their bench with the addition of Julian Schoenfeld to CIO, and he came over from CapREIT. And then despite all this good stuff you have going on, or great stuff you have going on, they're still trading at what I would call a bargain, basement bargain discount. They are trading at the lowest earnings multiple on FFO of any of the large cap REITs in our coverage. They're trading at about a 35% discount to NAV. And we just think the confluence of the earnings catalyst, the growth catalyst, combined with the valuation discount really presents a unique opportunity to generate outsized returns here in the next little while.
And I guess the retail REIT space, investors certainly were inspired to look at it more closely with this takeover of First Capital by KingSett and Choice Properties.
Yeah, so I unfortunately I have to be a little careful about what I say around this because we are research restricted as we advised KingSett on the deal.
Sure.
But certainly from taking a step back from the retail space and the REIT sector more broadly, it's obviously fantastic to see a deal. This deal was done above NAV, which is something we hadn't really seen in the last few deals that had come to fruition in the REIT space. And one of the big catalysts we've been waiting for is to get the generalist investors' eyes back on the space, and that's both the Canadian generalist. It also includes the U.S. REIT investors and U.S. generalists, because that's what's really going to move the needle. So we're really hopeful that this deal does exactly that.
Your next idea is Sienna Senior Living. Now, I know we can't get into all the technicalities, but is this actually a REIT?
Fair point. It is technically not a REIT. It is a corp, but they do own retirement homes and long-term care homes.
Yes.
There is a significant operating component to the business, which is a little bit different than the commercial REITs that we cover. But it does fall under our purview. It is considered real estate.
Sure.
And, it's Sienna and Chartwell are the two. The big difference between them is Chartwell is pure play retirement, whereas Sienna is, call it, roughly a 50-50 split between retirement and long-term care.
Right. And certainly it has a yield north of 4%, so it's very like a REIT, I know.
Yes, in that regard, absolutely. The cash flows are fairly stable. I mean, the LTC business is almost more like infrastructure. You're government funded. You're virtually guaranteed to be 100% occupied. And typically revenue growth tracks in line with inflation. Now, this had been a sector that was, as I'm sure many people are aware, hit exceptionally hard during the pandemic. To the credit of the government, they really made a concerted effort to right-size the funding to reset the sector back to what it had historically been, right, which was this bond-like type of asset class, and that's where we are today. But what I think makes the long-term care business particularly interesting right now is the redevelopment side. So for context, there's a lot of older homes, built in the 60s, 70s that are no longer considered serviceable. And as a result, the government, particularly in Ontario, has put together a program to build or redevelop about 58,000 beds. And as part of that, half of this is basically redevelopment of the older stock. And one of the big issues that the sector had faced, or this program had faced, is in higher cost regions like the GTA, particularly where land costs are significantly higher, the program wasn't sufficient for the developers to get yields that would hurdle. And as a result, you weren't seeing projects built in the GTA, which, as Ontario's most populous region, desperately needs them. So last year, they dramatically enhanced the funding. They basically doubled it. And as a result, we've seen a big increase in the amount of development starts and projects moving forward in the GTA. And Sienna, which has a big Class C bed portfolio, about 2,000 beds, 80% of that's in the GTA. So with that program being augmented as it was to allow the redevelopment of these homes, it's a significant opportunity for Sienna. And they actually just announced their first GTA redevelopment, about 450 beds, when they reported results back in February.
And then finally, RioCan, we're back to retail REITs. Tell us what's the attraction of RioCan? I mean, obviously, it's been the giant of the sector for a long time.
Yeah, and it's had its trials and tribulations. There were concerns around condos, and then you had in 2024 there was a wave of bankruptcies early in the year that hurt it, and then obviously we had the HBC bankruptcy last year. But we really think in 2026 and beyond, the company is well positioned to get back to basics. They are selling out of their multifamily assets. The HBC story is largely behind them. They've effectively dealt with the vast majority of the 10, 11 locations that they had. It was a little bit more complicated because it was a joint venture that they had, as opposed to a Primaris, as an example, where HBC was just a tenant. But that seems to be heading into the rearview mirror. And what they've done is they've recently introduced a core FFO metric, which basically excludes anything related to condo sales, to the apartment portfolio, as well as HBC. And that should give investors a much clearer idea of the underlying earnings power and productivity of the core business, which I think is where they ultimately want to get to. Core FFO is effectively an aspirational FFO for them. And we see a real path to simplifying the business or continuing to simplify the business, I should say, over the next, 12 to 18 months. And at that point, you've got really the only large cap retail REIT left in Canada with the FCR acquisition happening that doesn't have a sponsor or significant shareholder. And we think that presents a really unique value or a very unique opportunity for Canadian investors. And, much like Primaris, this is another REIT that still continues to trade at a not as significant of a discount, but certainly in the context of the retail REITs, which have traded up quite a bit, still at a relative discount to its peers and a relative discount to where it's traded on the long-term average. And we frankly think that if all this comes to fruition, that gap should close, and there's some good upside there.
Thank you very much. Really appreciate it.
My absolute pleasure. Thank you so much for having me on.
Lauren Calmar, real estate analyst at Desjardins. Coming up, one last check on the markets and some of today's notable analyst calls, including a pessimistic verdict on West Fraser Timber. JP Morgan cutting its price target on Magna to $70 from $71 US. However, sticking with an overweight rating, the company broadly adjusting its verdict and its targets on auto rentals, parts suppliers, and tires as part of a Q1 preview. JP Morgan is calling for a good quarter for suppliers, but it has cut estimates beyond Q1 to reflect a softer economic environment. And Scotiabank is upgrading Rogers to outperform from sector perform with a price target of 60.50 Canadian, up from 57.75. And this follows the company's decision to cut CapEx spending and focus on improving free cash flow. And we did see quite a rally yesterday in Rogers stock. Of course, investors awaiting the possible big sports IPO that might be coming from this company. And Rogers also upgraded at TD, TD citing free cash flow and the value of the company's enormous sports assets. Scotia, too, pointing to an expectation of improved free cash flow. And Raymond James downgrading West Fraser Timber to market perform from outperform with a price target of $75 US, down from 85. Now we're showing you there the TSX listed stock, the equivalent price target for the TSX listed stock, just over $102. Raymond James concerned that building materials are likely to see weakness near term in profit. Now, there is stronger lumber pricing, but seasonal price softening and economic uncertainty are expected to weigh on investors' sentiment. A quick look at the North American markets, and let's see how they're faring. Still no resolution in the Persian Gulf, and you can see U.S. stocks, S&P 500 now just holding its own. The TSX marginally higher. We did see, as I mentioned, strength in some of the big banks. Let's have a look at Constellation Software. John Zechner, a longtime guest on the channel, very kindly updating me there. Appreciate it, John. It looks as though Constellation is selling off in sympathy with a bunch of software stocks in the United States. And there's renewed fears about the hollowing out of the software industry. Oh, look at Constellation now down so it's half its value almost in the past year. ServiceNow coming out with commentary or a report that revived concerns about AI disruption. And ServiceNow shares NOW down as much as 16%. Salesforce, Workday, Snowflake, all dropping quite significantly. Even Microsoft down a bit. Although it's interesting, I just saw a Bloomberg story about a law firm in the United States apologizing to a judge. This is Sullivan and Cromwell, the law firm, apologized to the chief judge of Manhattan's U.S. bankruptcy court because they made a court filing with AI-generated hallucinations. And I guess the judge wasn't delighted with that. Let's have another look at Teck Resources. Now, the company did warn of higher fuel costs for its giant mines in Chile. It did see its surge in profit in its latest quarter. The stock up, and I think a part of that is Anglo American, which is about to swallow Teck Resources in return for stock Those shares jumped 5% in London on word that on a report that the company is has 3 suitors for its coal-making business, steel-making coal business. That's after Peabody Coal of America walked away because of a fire at one of the mines. But it looks as though Teck Resources, which of course is largely trading on the takeover, getting a boost in sympathy with Anglo-American there. Do we have time to have a quick look at some of these? Oh, we're out of time. Anyway, the cannabis stocks rallied sharply yesterday, and some of them up again today as America moves marijuana to a less harmful drug classification. Thanks for watching our show.